Okay, so hello, thank you everyone for joining us. My name is Angie Aki. For those of you that don't know me, I am the owner and founder of Ohana Investment Partners, and I am here with Sean DiMercurio. He is my personal and business CPA, and he has been gracious enough to spend some time with us this afternoon to walk us through a K1 and help us understand, and really easy to understand, digestible terms, which is one of the many reasons I love him. So that we can understand it and you know what it means to you as an investor. So that being said, I'm going to hand it over to Sean.
Thanks, Angie. I really appreciate it. So real estate is probably one of my favorite passions. My family in every aspect has been involved in real estate. So from growing up to a child to today, we're involved in it in some way, shape, or form, which is probably why we get along so well, because we understand the language of real estate and business. So Angie has graciously given us a K1 that someone shared with her. We redacted all that person's information, so it's just stuff that we can share with you. But we'll start with the cover page, which a lot of people just throw these away or skip these, but they kind of have a lot of important information on them, like the name of the entity you invested in and a bunch of gobbledygook. And then this person, whoever prepared this K1, it was not us, put this beautiful language. I know ours don't look like this. Ours look pretty. On the bottom, it says there's a bunch of information here about losses and just different stuff. So just make sure you read these. I'm not going to go into a lot of this because we're going to talk about it below, but you never know. Sometimes preparers put stuff in there, so you always want to pay attention to what's there. Oh, whoa, that was special.
That was,
yep, yeah, fix that.
We may have to. Oh,
I know. I don't know how that works.
I don't know either. What'd you do?
I just went to the next page.
All right. Hold on.
That's okay. It's showing both pages. I can just do the left one first.
That's okay. Technical difficulties. There you go.
Yeah, but not showing your screen.
Yeah. Got it. You can,
yeah, there we go. I'm gonna do it this way. We're good. It's all right. All right. Everyone can't see it, just let us know. We're just gonna kind of go through it the way it is. Sorry about that, guys. Oh my gosh.
Here.
Yeah, you gotta fix it.
Bear with us 1 second. Sorry about that. Let's see. What if we did this? We may just have to leave it. Single page.
Yep. There you go. Now,
Right,
yeah.
together we can figure this out. This is why we work together.
Nope, so
No, that's still not doing it. You know what we're gonna do? We're gonna do this.
Open it in Adobe.
No, I think we can do this.
Okay.
Can we do this?
Yep.
Is that?
I'm good
Okay.
with it. All right.
All right.
So we're gonna blow this
We
up.
can- yeah, I was gonna say,
here. There we go. Okay, perfect. So this is what the K1 looks like that most of you will receive. We're gonna go through most of these boxes just to walk through what it looks like and what this stuff is. So top, very, very top dates are really, really important. This fund or the syndication had specific dates of when they started and when they ended. So it started in August and obviously through the end of the year. And I guess I should have jumped into what is a K1 and why we get one.
Yep.
Probably really important, right? So what is a K1 and why do we get them? There's certain types of entities that aren't taxable or that don't pay income taxes directly. Instead, their owners or their investors pay taxes instead. So that typically will occur with partnerships, real estate funds, syndications, things of that nature, where you invested money into there. And then instead of that entity paying the tax or getting the benefit of a loss, you pay the tax or you get the benefit of that loss directly. The K1 is how that entity, fund, syndication, whatever word we want to use there, how it reports that information to you. Typically, if you're in Florida, you're going to get one K1 that's just to you. However, if that fund, entity, whatever it is that we're going to call it, is investing in real estate in other states, you might get a plethora of K1s. This one in particular has K1s from 3 different states, plus your federal. So we'll walk through some of those and what those look like too. And there's special states that I don't really care for, so I'll love it walking you through those. So that's what it is. That's why we get it. It has lots of important, juicy information. By the way, don't lose these, keep these. We've had so many clients that have come to us and said, I invested in this and this is what it reported, but that's not right. But they can't give us the old K1s. And if you look at someone's tax return, it doesn't give you the same information as on the K1. So throw a folder on your OneDrive or your Google Drive and just dump all that data in there. I promise you one day someone will ask for it, and it's really important that you keep it and have it.
Also, just to butt in, because that's kind of how we operate anyway. But it's important. I had an investor ask, do I need to wait for my K1? Can I go ahead and file my taxes?
Right.
So I would say, and I'll defer to Sean and all things tax, right? But if you, I know some people get penalized if they file an extension. You can amend your returns if need be, but in an ideal situation, you're waiting to get your K1s. You filed an extension, and then when you get your K1s, then you're moving forward with your tax return. And the K1s, I know, for those that have invested in syndications or funds within Ohana Investment Partners, we are working to get you your K1s as soon as possible. They are delayed. So if it's a fund model, it may be passing through another entity into our fund, and then we have to disseminate the K1s and get, so Sean and his team are working on some of those for us right now. Some of them, it's just a process that we are waiting on, and we're working on getting the information. So they're often delayed. I typically will tell investors from day one, always just file an extension, because if you get them in time, it is what I like to call a Christmas miracle, but it's highly unlikely.
So it's funny you mentioned that. I actually have a personal investment in a fund that does not issue me my K1 to my entity, because I don't have it in my own name. I have it through one of my corporations. I don't get it until September 15th, which is actually the due date for my corporation's tax return. So, and it's because I'm a partner in an entity that's in an entity that's in an entity that's in an entity. There's a whole waterfall that goes through there. And so it gets confusing. One thing though that usually will happen is, and it's important to know, is when we file an extension, it's an extension to file the paper, not to pay the tax. So if you think that that fund is going to have taxable income, you should probably make sure you make an extension payment to cover that. Most funds know where they are at year end. They can give that information out. Bigger funds will actually disseminate these draft K1s or information for their investors as well. So it just depends on how big it is. If it's the first year or not. A lot of times the first year, you really don't know what's happening. It's a brand new fund. There's lots of movement. So just pay attention to that. Work with your CPA on these things and work with the fund as best you can. And remember too, funds have a lot of investors that are asking lots of questions. So just be careful, Angie, because you get they get inundated with all these questions as well. Is that fair?
That's fair.
Yeah.
Thank you for that.
Yeah, of course. Yeah, figured. Left-hand side, information about the fund. First is the fund's EIN. We don't really care about that as much. The next is the fund's name. This is really important. Make sure you actually invested in the fund. I've seen circumstances where clients have gone, I didn't invest in this entity, I invested in this other one. And it just so happened that that fund sponsors, started 2 or 3 entities that year, and their CPAs messed up which entity each person went into. It happens. Just make sure everything is correct. It's easier to fix it in the beginning. If you amend returns or do stuff, it creates a little bit more complications. So we want to do things as best we can up front.
So question to that, because
Yeah.
I got a K1 and I had a question. And so my legal name is Angela, but my K1 said Angie Aki.
Yep.
Does that matter? Is that important? But it still had
Yep.
my social security number
Do you
correct.
want me to tell you why it said that?
I don't know. I don't know, because we're recording, but
when you signed the offering document, you wrote Angie Aki.
I did not.
You wrote Angela, then they totally messed it up. So most companies, what they'll do is on that offering document, people should never use their nicknames. It needs to be your legal name. If you have a trust, if you have an entity that you're investing in, all that kind of stuff, get it right there.
Right.
And if it's wrong on these documents, then reach out to whoever sent it to you and say, this is wrong, here's what I gave you. And do it as fast as you can. Most companies and most CPAs that file these types of returns, we don't e-file the return for a few weeks after we send it out, because we know sometimes some changes comes through. Otherwise, it creates a costly error for everyone involved. So we want to make sure we're notifying everyone ahead of time. It's not the end of the world for you, the investor, for Angie, because yours has your social security number on it and has that information. So the IRS can match up the info, but it's more of a legal thing of if something happens to you or your family, you want to make sure that everyone knows I owned this. This is mine.
Okay.
Make sense? All right. So next box is who's the investor, their social security or taxpayer identification number. And then next is their legal name, which is the question you were just asking, and their address. Sometimes we all own things through LLCs where we're the sole member of that LLC. If that's the case, you'll actually see your information on here twice. The IRS can't make anything super simple. Up top would actually be if Angie, if this was yours, this would be your name. And if you owned this through Angie Aki LLC, it would actually show that information in H2. It would say that entity's number and name as well. Again, super confusing, which is why we want to make sure these things are always done really, really well. And then finally, what type of entity is it? An individual, a trust? I don't really pay attention to this too much. It doesn't have a ton of bearing on the K1 itself. But again, it's just nice to look at this and make sure it's right. I'm a big fan of saying, the details matter. And when you're working with a team that really pays attention to all those details and gets it all right, usually if they can get the small stuff right, they're doing the big stuff right first. I hate to find out the big stuff was messed up and then we notice all the other little stuff was screwed up too. It just terrifies me. And then last in this little section here that's really important is our profit and loss percentages. Some K1s will show how many units you have, some won't. But simply put, this is typically just the number of units whoever invested on this K1, their number of units they own in the partnership divided by how many units were available. They came out to 0.6%. The capital percentage is usually the same. If it's not, it's just how much capital down here divided by total capital. These are not as important for the K1 to understand, but you should know what these are because theoretically the numbers on your K1 is the total of what the syndication, the deal did, times this percentage that's here. You do want to make sure you're getting allocated your fair share of everything. The next piece is really important for real estate when we're investing in certain real estate deals. So the top line is our non-recourse debt. This whole section is about debt, and it's debt that the partnership itself holds, and you're pro rata piece of that debt. The reason is in partnerships, in particular, if your capital account goes negative, this number down here, then technically, usually you can't deduct losses generated by the partnership. However, real estate has a beautiful carve out in the Internal Revenue Code because real estate people paid some really good lobbyists to make sure this was in there. And that part is right here, qualified non-recourse financing. What that means is we can use debt that the partnership took on to invest in real estate as if it was our own debt, as if it was our own capital in the business, and we can write off our losses against that too. In the beginning, not such a big deal, but if you hold these deals, especially these big syndication deals, for a long time, eventually they keep on financing these deals over and over again and distributing out cash. This little line is what makes those distributions tax-free. Pretty cool?
Oh,
yeah.
that's magical.
That's magical. I love it.
We love magical things.
I love tax-free. The last section here is really important too. So this is your capital account analysis. It's on a tax basis. So if you're looking at a report from the syndication or the fund, and it says your numbers are a little different, that's why. The IRS used to allow us to put these on the same basis that your reports are on. A couple of years ago, they said, nope, get rid of it. Very complicated mess. And now it's on tax basis. So basically it's how much capital do you have in the fund last year? The next is how much money did we put in this year? So this is a brand new K1. We know that because if we look up here, we should see a little checkbox that says, oh, there's no initial, sorry. But we know because of the dates up here. And then if we go back down, we'll see, hey, 50,000 went in. We were allocated tax losses of $10,772. We'll talk about that, but we should be able to deduct those on our tax return or at least get them at some point. And after, no distributions or anything, and there's $39,000 left. This doesn't mean how much the partnership's worth. It's not market value. It's none of that. All it means is that I put 50 in cash in, the partnership lost $10,772. That's my portion of it. And I'm left over at $39,228.
And so that loss, right? And we talk about with cost segregation and bonus depreciation, that loss is a paper loss. So it's not correct. It's not necessarily that, the syndication or the fund is bleeding out money. I just want to explain that. So when we talk about cost segregation and bonus depreciation and the many, many benefits of investing in real estate, depreciation is one of those. So this negative 10,772 can be that, correct?
It could be a lot of different things. So the partnership might file on a tax base or something like a cash basis or an accrual basis. So which changes things. And then either or for both of those, depreciation is not really a cash event, right? We already bought the asset. Depreciation is us writing that asset off over a period of time. So that number, and we already know that because we were reading ahead in the K1, a good majority of that number is that cost segregation study that's sitting there. So you're right. It doesn't mean the partnership lost a massive amount of cash flow, but it did have a tax loss. You should be getting other reports from the partnership with the syndication, real estate deal, whatever we're calling it. We should be getting that. Let's just call it a partnership. Is that fair? We're going to call it a partnership. Does that work? So from the partnership, you should be getting separate reports that actually show these other answers that give more detail about what that means.
And then I know you mentioned distributions, which is not shown on this K1, but in the event there was a distribution, it would be shown just above the ending capital account, correct?
Withdrawals and distribution. So
Okay.
usually it's either the amount you've already received during the year. Once in a while, they'll date checks 12/31 and send them out on 12/31. So sometimes it'll look a little different from what you actually deposited because you got it. But under the IRS's rules, if they mailed it, you got it.
So this would be any preferred return payments,
Yep, all
right?
of it.
Any return of capital, return on capital, anything there, cash flow, equity, anything would be listed there for you.
It
correct?
would, yes, and you actually bring up a great point. This is again, tax basis of your interest in the partnership. It doesn't break out a preferred return. It doesn't break out if you're earning interest on your capital account. Some syndications pay you an interest rate on your capital account balance. It doesn't show any of that. It's just the tax rules get applied and here's your numbers. So those are again, places where if you're investing in these deals, you should really understand them. And then also make sure we're keeping track of some of that stuff, even if it's on a pad of paper. I have a real estate investor, a client of ours that's from, let's say Massachusetts. That's not where he's from, he's from a different state. But you never know if he's watching this.
Yeah.
But he started a little business and took every dollar he had and bought real estate. And he's much older now. He has probably about 50 million in real estate. And he has a thick yellow pad that he keeps everything in. And I laugh because every time I have a question, he spins through it and goes, here's your answer. So like,
My kind of guy.
yeah, it's not like this perfect Excel spreadsheet or anything, but it's enough where he has his detail. It's important to know those things and track those preferred returns. I've seen they've messed mine up before in deals.
Yeah.
So you got to make sure you're looking at them.
And it is, I mean, you're dealing with your fund managers or your operators or syndicators, and then you're also dealing with an accounting team or sometimes two.
Mhm.
So there are, I mean, everyone's human, right? You have humans touching this information. It's not something we're going AI with, right? Like it's just not gonna happen. Hopefully
Yeah.
not. Well, I'll let you know. I'm not, right? But mistakes can happen, so it's important we quality control it. So it's quality controlled from an accounting standpoint. It's quality controlled from an operator team, syndication team, fund manager team, whatever you want to call it. But you, as the investor, should make sure that the information is correct as well. Just like we ask you before entering into any investment or syndication, you do your due diligence to make sure it's the right opportunity for you. Same thing when you get your K1s, go through them and make sure nothing's missing, everything's correct.
Be really nice about it. They'll help you out a lot faster too. It's true. All right, so that's the left-hand side of the screen. We're gonna go to the right-hand side. This is where all the meat is. Lots of boxes, lots of complicated stuff. I'm gonna go through a bunch of them, even if there's nothing on here. I clearly know by just looking at this deal is only invested in real estate. How do I know that? Box 2, net rental income or loss. Net rental real estate income or loss. This was an active business, a business where we were selling widgets or doing a restaurant or something like that. Those numbers would be in box 1. So most real estate deals, syndications and whatnot, partnerships are all issuing their numbers will always show under number 2. Rarely will you see something show up in number 3. Once in a blue moon, usually very old school CPAs because they have a different interpretation of what box 3 means. But if you're dealing with, the cool kids, we always usually put everything in box 2 because that's where it really goes. There's some other boxes here. 4, we don't really deal with anything in real estate. 5 is interest income. So if you're dealing with a syndication, they usually have lots of cash reserves or earning interest on that cash reserve. It could show up in box 5. That's your portion of that. Box 6, once in a while, we do see things in box 6A and B. The reason is, again, these big syndications will invest in bonds to help mitigate risk in their cash. They're holding cash back for improvements and different things. And so they're just trying to make some money on that. Sometimes that comes through as a dividend. So it's going to be showing in 6A or B. Don't see it often, but it could be there. Royalties, we don't usually see in real estate, so we're going to skip that. Box 8, 9A, and 10, all deal when the fund or the partnership starts selling real estate. 9C as well. So short-term capital gains or losses, sometimes from securities, but usually in real estate, especially the cost seg study, a portion of the cost seg study's assets that were written off have to be recaptured, and it happens through a short-term or long-term capital gain. And the rest of it usually shows up in box number 10. Again, it depends on those underlying pieces, but when they're selling off real estate, numbers will start flying in these areas. Pay attention to those things and make sure, this is my thing, if you ever see numbers in those boxes, that means they sold something. I better expect to have gotten a distribution if they were selling assets. If they weren't, I really would expect to see my beginning debt decrease massively because that means that they pay down debt. And my final little tidbit on this is most of these agreements, and make sure yours has this or should have, most of these have them, they require a tax distribution. If there's a profit, the partnership pays out at least a portion of it for you to cover your taxes. That's in most of these agreements. You were going to say something.
So for the, for box 8, right? Can you define, or is there a definition, right, of the short-term capital gain versus long-term? Is it 12 months? Is
12
it
months.
12 months?
The real rule is 1 year plus 1 day. So
Okay.
365 plus 1.
So you
They
want-
don't say it like that because of leap years, because then it
Mhm.
confuses everybody. So 1 year plus a day. So if you have it for 12 months, it's usually long-term, less than 12 months, it's short-term. In a real estate deal, though, in a syndication, like this big office building we're in, you know, if they wrote off the walls and stuff under a cost seg study immediately,
Mhm.
that would actually can be considered to be long-term or short-term, or might even go into rental. So it just really depends on how they
Okay.
handled it and what they did. The important thing for us to understand, it's really important in real estate because we talk about depreciation recapture. So the typical rule, sans real estate, is if I bought a chair and I wrote it off and then I sold it, if I sold it for a profit because I bought it for, let's say, $1,000, I wrote it off to zero, and I sold it for $500.
Mhm.
Well, because I wrote off $1,000 of it, that $500 is actually ordinary income. It's called depreciation recapture. No special tax rate there. I actually have to pay my normal rate. Real estate has a caveat. You don't actually have to get depreciation recapture on real estate. Why is that important? It lets us keep it being taxed at qualified rates, 0, 15, 20%. So it's a beautiful thing to really understand. We invest in real estate, you get a bigger bang for your buck on the sale.
So let's talk about that for a second. And I know we're diving into K1s. We're taking a couple sidebars, so just bear with us. Hopefully this is providing some value to our investors. But when you're through cost segregation, right, you have bonus depreciation, that recapture, you said it's a portion, right? So
Correct.
can you help us understand that? And if we're getting a bigger bang for our buck, what does that look like? Let's say we're investing, I mean, round numbers, right?
So yeah, no, we'll walk through a cost seg really quick, and then this gets confusing. It's probably a good thing for another one to go actually go
Yes.
through so people understand
And
it.
we will, so
Awesome.
we'll do that, but
So
10,000 foot.
yeah, 10,000 feet. Why are cost segs important? How does it really impact all this? Really fast. If we buy a piece of commercial real estate, the land portion of that deal cannot be depreciated ever because land doesn't depreciate, it only appreciates. But the building gets written off of over 39 years. 39 years, holy crap, that's like a lot. Like, why would we ever do that? Can't we write off the stuff that's not going to last 39 years? Why, yes, you can. You get a qualified engineer and a CPA. There's great firms out there, and they actually are usually owned by engineers and CPAs. They write these really thick reports and they go through and say, I know you just spent $10 million in this building, but just so you guys know, of that 10 million, 6 million, you got to write off over 39 years, but the other 4, you get to write off 80 to 100% of it today. And here's the why. And so that's where that bonus depreciation comes through the cost seg study.
So if you're writing that off though, and then there's a recapture rate, what happens with, because a lot of syndications, let's say 5 years, right? That's a good average hold time. So a lot of these multifamily syndications have bonus depreciation, cost seg studies done. What happens when that asset is sold in 5 years? What's recaptured and how does that impact the investor?
So what happens is the portion that was allocated to those assets that we write off immediately, we have to recapture that, and we pay ordinary income tax rates on that.
Okay.
So that typically is hidden in box 2. It gets jammed in there. The rest of it for the building portion, that 39-year portion that they're writing off, if it's multifamily, it's usually 27 and a half years, the same concept, right? That stuff will usually come through right here, box 10, as a 1231 gain. And for most people, if they're in higher income tax brackets, it's maxed at 20%. Whereas our individual tax rates can hit almost 50% taxes.
Okay.
So again, just another really reason why people like you and me like investing in real estate.
Yes.
Because
if
we have good cycles and good pieces and we're paying this great tax rate, I mean, why would we not want to do it?
So even when it's recaptured, you may pay a max of 20%.
For the building portion,
For the building
not the
portion.
cost seg portion, yeah.
For the, okay,
Gets
gotcha.
confusing. That's why I said we'll dig into it. Yeah.
We're gonna keep going on the K1, but just wanted to sidebar on that because I have had a few people
Yeah.
ask that recently because there have been a lot of cost segregation studies done, a lot of bonus depreciation. I know that's phasing out, unfortunately. Hopefully it won't.
It'll come back. It's 80% this year, and the section 179 is still around. So we'll still see it around. We're actually working on an article for our website on cost segs too, so we'll make sure to let you know when that comes out, and then we'll do that as well.
Yeah.
With our content team. 12 usually won't see anything, or excuse me, 11, 12, you probably won't see anything either, because usually section 179 doesn't apply for real estate. It does in some circumstances, but we're just gonna do that. And then 13 is other deductions. If they donate any money to charity, things like that, you'll see that here. Also, sometimes in 11 or 13, I can't remember which one, when partners come in and out of real estate, there's special or partnerships, there's special accelerated depreciation methods that can be used for those things happening. It has nothing to do with the building. It's just the partners coming in and out. Sometimes you'll see a little special depreciation adjustment there just for you personally. Just a nice little add back. We'll do another thing on that as well. I don't want to dive into that. 14, self-employment. The whole reason we invest in real estate is it's considered passive even when we're active, which means we do not pay payroll taxes or self-employment tax. Credits, you won't see this tipping on real estate, so we'll skip that. 16, this is the worst thing in the entire world. There used to be 4 lines here, maybe 8 lines here with numbers on them. The IRS was brilliant and they decided, we'll show you. It's literally like 5 pages and like 20 columns wide now. But thank God, if you're not investing in something that has foreign assets and you're not a foreign person, you don't have to look at it. So that's nice. AMT typically just deals with the alternate minimum tax. Again, nothing on this one, so we can skip that. Tax exempt income, sometimes you'll see amounts here, sometimes you won't. Same for distributions, that usually will tie out to our distributions down here. And then last is a couple other pieces of gobbledygook, but they have these little stars, and it's really sad when the CPA knows what tax software is used to prepare this just by looking at it. But the stars mean there's more detail on the next page, so we're gonna go there. And then again, no foreign taxes paid or accrued. And this stuff down here, we don't need to really deal with real estate as well. So this is a general form that you could have $1 billion partnership or one that only makes $10 a year. They file the same complicated form. It's kind of how it is. We're gonna go to the next page if this likes me. Maybe I have to hit the.
I think, did it not go?
No. Oh, there it goes. Okay, that's
There
it.
we go.
That's it. Oh, so special.
It's like
Maybe
every
it's
week
just
not
me.
breathing.
I know,
Yeah.
it's so scary, isn't it? So the next one is that box 20 code N. All it's saying is business interest expense. It's a separate amount. Why is this important? There's rules about interest with different types of entities. For individuals, you're fine. We don't need to worry about it. The next is section 199A, a very important one for all of us to really pay attention to. So this deal only has one property that's involved in it. And I can tell by how this is set up. If it had 4, it would actually list 4 separate sections here. 199A is the special deduction that was created under the 2017 tax laws. And so basically what it says is if you had income in all of your entities that you invested in, that you get an extra 20% of that amount. So if this said $100,000, then you get an extra $20,000 tax write-off. That can't be true. There's like something, it's too good to be true. Well, you're right. There's some rules with that. Part of those rules are it's limited by a calculation based on wages or a calculation based on unadjusted basis of assets. This is whoever is K1, this is their pro rata portion of unadjusted basis and assets, 44,000, and then their pro rata piece of the W-2 wages. That formula is done on your personal tax return. So no one will know what the answer is until your whole tax return is done and the numbers are calculated at that level. Basically, the way it works is everything gets aggregated together and then they run the formulas. So can't go into how it works because it depends on the person, but that's really important to look at and make sure you understand as well. There's a carve out for real estate, which is why the unadjusted basis of assets is so important. For most businesses, W-2 wages are more important, not for real estate. And then it's disclosure that's down here. Every K1 has this. It's about 199A. If you're using a CPA, don't worry about it. If you're not, if you're typing into TurboTax, pray a little, but it's okay. All right. Oh, that's what it does. You have to go back up to the top. See, it does show it. It just does it really weird. And the last page, doesn't have a lot of detail, but I'm actually going to go up 2 pages to show you. If you look right here, it says current year net income or loss minus 10. Well, if we go back to that page I just looked at, it actually breaks that down into pieces. Now for this one, it's just one item. But if you had interest income and all that other stuff, it would break that down. These 3 pages could be 20 pages or 10 or 2 like this is. It all depends on how big the partnership is and it depends on who the CPA firm is. Typically, the more sophisticated the firm is, the more knowledge they have, the more questions they will make sure are answered by providing that information in the K1. Because their goal is not to have the fund, all of you, getting called. They want to make sure that data is there. It's also a really good, important thing to see all this data. If you're not seeing it, I always question the CPA just a little bit. Doesn't mean they don't know what they're doing, but I want to make sure they're really showing you everything they're supposed to. There's a lot of rules in tax world where we don't have to show information, but if you've been doing this long enough, and I have a lot of gray hair, so I probably have been, you want to show as much information as possible because transparency, is really important and it really helps everyone understand what's there. The less questions, the better. We want to make sure we tell you everything that you need to know. Good.
Agreed, yes. Maybe the gray hairs from working with me.
No
I
comment.
have a 79-page K1 for you.
I'm gonna go cry. Those are fun.
That's after every meeting with me. No.
The last is footnotes, and footnotes are just special things that us CPAs put on here. This one's kind of fun. It just says, hey, the amounts reported in your K1, blah, blah, blah. This just is, for this one in particular, it's just saying, I already read it because that just looks like gobbledygook to me. But all it says is, hey, if you didn't invest into this directly and you bought it from someone else, there's more information you need to know. It's actually a really sly way of whoever prepared this K1 saying, go talk to your CPA because what you think is on here might be a little different and you really need to understand these rules. And if you haven't heard me say it enough, having a really good CPA when you're investing and getting K1s is so important. There's so many moving pieces and it's just super complicated. And I'll be the first one, and even on our website, you'll see it. I always go use TurboTax if you have just a W-2. It's super simple. Why pay us? You don't need it. When you start getting complicated things that are happening, there's so many moving pieces that you have to make sure you have an advocate in your corner to make sure that they're empowering you and you understand this stuff and that they're paying attention to it. Super, super important.
That's the moment I switched to an accounting firm, is when I started owning real estate. And then I found Sean.
Oh, I forgot we weren't the first.
No, I didn't live in Orlando at the time. I don't even know how I stumbled upon you.
I remember. I'll tell you
It
after.
was- Okay.
The next page, again, this is just related to unrelated business taxable income. You don't need to worry about this. This is only for nonprofits or if you're investing through your retirement plan. A lot of people have self-directed plans.
And we have a lot of investors that are
doing
invested
that?
through their self-directed, yes.
That's
so.
fantastic. So if it's a self-directed 401k, this is super important. If it's a self-directed IRA, potentially really important as well. So we need to make sure that you're paying attention to that. And that, remember too, is it's not typically if you're investing through NewView, or I think the other one's pension something or that does this too.
There's a bunch of them now,
Yeah, there's tons of them. If you're investing through any of those, they don't take care of this. So again, there's not a lot of CPAs out there that really understand UBIT. It's a pain in the butt, but in a nutshell, it was a law that was created to say, even if you're investing through your IRA or your 401k plan, just so you know, if you're making certain types of non-passive income inside that thing, you're going to pay tax on it anyways.
But that's something that your accountant, once you give them the K1, your accountant should know.
They should be able to walk you through
Like,
that.
for instance, if I were to give this to you and you would say, Angie, you've invested through your solo 401k or self-directed IRA or self-directed Roth or one of the many retirement vehicles I have to invest in, you'd say, I got you, right? Like,
Well,
I
I
don't
mean,
have to worry about
I
it.
always have all of our
Yeah,
clients
you
back,
do,
because that's
I
my
know.
job.
But
Well, here's something
it's
important to know.
handled through you guys.
Yeah,
So it's
and
nothing separate.
make sure you tell them it's a self-directed if you're doing that. I know for us internally, we keep track of every entity separately intentionally because we always want to really look at that stuff. Numbers matter, limits matter, how much they're investing really matters. But also on this, it's still passive income. So when you invest through any of those boxes, like the 2-box or the short term or all that stuff, that's all passive. So it's actually not subject to UBIT. Whoever did this just added this information so that the CPA would know in case it was one of those types of entities. There's ordinary income, it matters. So we're good when we invest in real estate through our self-directed plans. That's okay. It's allowed and there is no tax due on it because it's still passive. So always a fun thing. The next few pages, this literally explains everything you just saw. And by explains, it just tells you where to put it on your tax return. So if you would like to go prepare your tax return with a green visor and a pencil, then this is where all these numbers go.
Don't recommend it.
Uh,
We are not legal counsel, but you're not recommended.
They would not recommend it. I'm trying to get it to go to the next page. Let's see. There it goes. Okay. So now we get into that K1 again, or K3, excuse me. This is for partnerships that have investors that are foreign or the partnership invests in foreign entities, meaning they're doing deals overseas. In the US, most real estate syndications do not cross borders. It's highly complicated. They just don't want to do it. So this is how they do that piece. I'm skipping it all though, because it doesn't really matter, because for us, we're not any of that. And if you even notice, everything said US on there, so. They're just preparing it to prepare it, which some CPAs do. We actually choose not to because people call and ask a million questions about it, and it doesn't apply. This is in some K1s, sometimes it's not. It really just depends on the CPA firm. Basically, all it's saying is it breaks out all the activities. So if this thing owned 3 pieces of real estate, it would show each piece of real estate separately, so that then they can understand, oh, I thought this thing made money. Why does it lose money? Oh, the parcel in Texas, the multifamily deal made 100 grand, and that was my portion. But then these other 2 lost a lot of money because we bought new deals, invested in new deals, brought in more partners. So on a net basis, I lost a little. This one only has 1, but it could have more.
So if we were to have a fund with a portfolio of 3 assets and you were to be preparing the K1, would these 3 assets be listed separately in each column?
Correct.
So then you would see this asset in Phoenix it would be your net loss or profit, right? So
Yep.
you'd see everything. And then this one in Arizona, right? And then this one in Texas. So you would see it broken out.
You typically would, if they include it. Sometimes they do, sometimes they don't. It just really depends, but I like to bring it up, and I like that they included it because for me, if there's multiple assets, I kind of want to know how they're doing on a tax basis. And there's a lot of rules in the tax code that require us to do this too. So.
Well, and that's something that we typically will communicate to our investors and say, hey, this is how the assets are performing, right, throughout the year. But then this gives you another quality control point, another data point to look and say, okay, this is what you said, everything was happening, right? And you've shared financials, you've shared communication, but now, right, this is where the rubber meets the road, and this is the financial end of it.
100%. So I'm not going to go through it because literally it's the whole K1 we just went over. So the last thing we're going to do is the states. Every state is different. Be prepared. The larger the syndication you invest in, the more complicated these are and the bigger the packages get. If you notice, this was a 29-page K1. I've received K1s that are over 100 pages long easily. They're complicated. We have clients that file tax returns in multiple states because they're getting these syndicated, they're invested in these syndications. The syndications have activities in all these states, and they have to file in all those states.
Yep.
Why are you smiling at me?
Because it's coming. It's coming.
So I'm going to go over a few of these just to show you kind of what this looks like. This is New Jersey. The top is typically the same in all these, so I'm going to skip all of that. What you'll notice is what they're saying is they're calling it total distribution. So they're saying, hey, New Jersey taxable loss, as if the partnership was 100% in New Jersey is $1,000, but whoever received this K1, your part's 0. You don't have to file a tax return here. I'm curious though, ours was 10, now it's 1,000. It's kind of weird, right? So typically, not always, you'll have a second page, not this one, because that's that little note that we saw. You'll have this beautiful page here that says, oh, wait, your federal depreciation was $10,361. Probably all bonus because there's a cost study done inside this thing. But New Jersey says it only can be $672, which means New Jersey makes you add back another $9,600. It's important to understand that when you're investing in these deals, typically all the depreciation, everything that's being talked about is at a federal level. It's not at the state's level. The states need money, they're struggling. Excuse me, they all want cash. Depreciation, bonus depreciation is typically not allowed at the state level. So when we were saying that cost seg study, it impacts a federal level, but at a state level,
Gotcha.
they say, so sad, too bad, you got to depreciate it over 39 years or whatever their rules are.
So does this New Jersey portion only affect the investor that's sitting in New Jersey, or if one of the general partners or sponsor team is in New Jersey, it would potentially affect them as well?
No, so it actually would impact every investor.
Okay.
If the partnership had assets in New Jersey. So I don't know where this partnership has assets, but what I do know is they're saying, hey, don't worry about it. There's zeros here. They still got to give you all the detail. So we'll notice when we get to North Carolina, which this one does have their asset in North Carolina, we'll understand that piece. But I just wanted to make sure we understood that there's lots of statements here. And some of these are not as clean as this is. This is actually, I'm pleasantly impressed with New Jersey right there. Our next one is New York. I absolutely hate New York. This partnership has no activity in New York. So I'm not sure why it's issuing K1s in New York and New Jersey. There could be a reason why. Maybe they registered in those states because they're getting ready to invest in those states. There could be a lot of different reasons why this happens. Sometimes it matters and sometimes it doesn't. But again, on this one, I'm going to kind of go to the next page. And what I'll notice is minus 10,000. There's some $34,000 adjustment here. But again, your amount, New York state amount, is 0. So I don't care about this one as well. I am curious what that thing was. See, New Jersey or excuse me, New York is just so crazy with how they explain stuff. You need a tax Bible, tax code book to read it all. Come on. I think it's mad at me.
There we go.
Oh, this is all the 199A stuff. So it's just how New Jersey shows it. Again, not important to New York. Not important because we're not doing there. Last is North Carolina, which we do know this one has a taxable event because I told you, and because we can see it. So the way North Carolina does it is a little bit different. They have some rules up top here, and they're all different on how they do it, but typical same stuff on your federal K1. The first portion is really interesting. It just says, hey, share partnerships income or loss, boom, that's federal. And then it says, hey, there's an $8,800 adjustment. Okay, thanks. And then it goes, hey, if you're a non-resident, here's some important information to know. This person who gets this K1 does not live in North Carolina, so they put these numbers here as well. Could be more or less, again, it depends on that state's rules. But I'm noticing this little adjustment here, portion of line 2 for New York or North Carolina. I'm kind of curious what that is. So we're gonna go to the next page and see. It might be nothing, it might be something. And on this one, there it is. Bonus depreciation. So again, what North Carolina is saying is, so sorry, $8,800 of your $10,000 loss, you don't get it this year because we don't conform to the federal guidelines the same way. Every state is different. Florida actually does something interesting. They let you do it over a 7-year period. Florida has no personal income tax, so it doesn't really matter, but corporations really care about that. So they can still get it, they just get it over a shorter period of time or a longer period of time, not 39 years, it's only 7. But you get my point. Every state's different. Again, if you're in a syndication that has investments in 5 states, you could be filing tax returns in 5 states. The rules depend on a plethora of factors. So you just have to understand what that is. The biggest thing I like to tell investors is just because you have a loss in a state does not mean you should not file a tax return in that state. Sometimes you need to file the tax return to preserve the loss. So if you think about it, in North Carolina for this one, this taxpayer might file a North Carolina tax return that shows that loss. And the client of ours might go, why am I paying you guys to file this return? There's nothing on it. I don't owe any money. I don't want to do this. Our response could be, because I don't know the rules of North Carolina off the top of my head, I want to make sure I preserve your loss. So even though it's losing money for 2 or 3 years, in year 4, it might make money. And North Carolina's rules might say, if you didn't file a tax return showing a loss, then you don't get to offset that income in year 4 with those losses. It's really important to make sure we're understanding the rules. Again, good CPAs can help you walk through this. TurboTax doesn't answer all this stuff on the states. I love TurboTax and not for stuff like this.
Only when you're W-2.
Only when you're W-2, yes, or the kids. And that's it. So this is just another piece of those states. So I think we went through everything. It was probably a little bit all over the place, but K1s are fun.
Let's go through and see. Also, if we have any questions in the chat. Okay, so we had a couple questions we just want to make sure we address. So if I'm an LP, instead of my personal name and social security number, should it be the name of my LLC and TIN? So yes, disregard, I saw that box H2 on my K1, yes. So you answered your own question, I love that. But yes, so it will list, as Sean mentioned, it'll list your name, right? And your TIN.
Yep, I'm gonna say it depends, right?
Okay.
So if you own, so if I own 100% of Sean DiMercurio LLC and it's not a corporate, an S corp or anything, it's just a disregarded entity, I would actually have to put Sean DiMercurio with my social up here. And then right here, I would put Sean DiMercurio LLC. So if you don't want to even show your personal information, make your LLC, make it a partnership too. So let your spouse own 1% of it, you own 99% of it. And then it's not a disregarded entity, and then you don't have to disclose that personal information. I say that just to say there's always ways around stuff. I hate showing my personal information on stuff I don't have to. The bigger reason for me is that a lot of, and we don't do this, but a lot of CPAs and a lot of fund managers just email K1s without securing them. And like, I just, the whole data stealing thing just freaks me out with that. So you just gotta think through that stuff.
Okay. And I think that's all the questions we had. If anyone has any additional questions, please pop them in the chat and we'll make sure that we answer them. Hopefully this was really good information, whether you are joining us live or we will make sure, I know there were quite a few people that registered and weren't able to make it today. We'll make sure that you get a recording of this. And then I will also add it to my YouTube channel as well. I think Sean mentioned he may have it on his site as well. And you can look forward to some additional information from Sean coming coming in the near
love
future,
it.
right?
Thanks, Andrew.
Yes.
This was fun.
Yeah, this was a good time. Thank you so much. I appreciate everyone's time, and we will see you next time.